Man, that beat makes me just hype, man. What's going on, everyone? It's Thursday. Happy Thursday. My name is Pedro De Leon.
What's up, everybody? And I'm Chihiro Kurokawa, and Pedro and I are Beyond Stocks. So, we're regular guys talking about alternative investments, and our goal is to talk to people who have high income and want to learn about building wealth through something more than 401ks and mutual funds and stocks and bonds. And that's why we focus on alternative investments, right?
Absolutely. Definitely, there's a lot, strategies out there that exist that we are still learning about. So, yeah, it's just a great journey.
Yeah,
So, talking
absolutely.
about alts, man, let's talk about what's going on right now. What's going to happen next year, man?
Yeah. So shout out to our friend and listener, Jim D, out in Orange County. And I actually saw him at our event in Newport Beach a couple of weeks ago, event with my firm. And Jim sent me this amazing article from Barron's, but here's the gist of it. So this is very current, just less than 7 days ago. So on June 6th, Barron's wrote that they expect that by the end of 2026, the Trump administration is expected to make it easier for everyday investors to invest in alternatives. So
Mm.
now this isn't just one piece of legislation that's being contemplated. It's kind of a combination of things. But the long and short of it, there's over $30 trillion that are held in individual retirement accounts and 401ks. And virtually all of that, or a substantial portion of it, is invested in traditional assets, right? So the alternatives industry would love to get a piece of that.
Mhm.
And that is what's being uh, talked about in this Barron's article.
Yeah, something that I would like to touch is that there is a lot of people may not understand, like, why would I want to invest through my 401k into an alts, right? It's just another passive way of investing. That's essentially what it is. And there is a lot of people that just say, I would like to have more control. So that's when you become a GP. So you can understand the difference, right? LP and GP. So this is mostly for those that want to be an LP, have their active work, either their business or they have a professional job, but say, hey, I need to diversify it into something that I can get residuals for the rest of my time, right, until I retire.
And let's clarify, Pedro, what you meant by GPLP. So,
Mhm.
if we talk about this in a public equities context, meaning stocks, a
Mhm.
GP would be Coca-Cola, essentially, the managers of that business running that business. An
Right,
LP, I'm using an analogy here. This isn't exact, but an LP would be just a stockholder.
right,
You don't manage Coca-Cola. You don't know anything about their business. Like, you just own their stock, right? So similarly, in a private equity fund, the general partner might be KKR, or it might be Carlyle, or it might be a local uh, commercial real estate syndicator.
hmm
That's the general partner who's running the deal. They found the deal. They operate it, but he or she has limited partners who are silent partners that do not have any managerial responsibility. So it's analogous to that Coca-Cola stockholder, where
right.
they don't run the business, but they earn a profit, or expect to earn a profit through the efforts of Coca-Cola, the company, or in a private context, the general partner's efforts.
Right. So this is definitely, well, I think with everything, right? There's good news and bad news, right? And let's just kind of go with the pros for this. The good news, right? What are some of the things um you think is going to be advantageous for people?
Well, so that 30 plus trillion that's in these retirement accounts, uh, the vast majority of it is invested in stocks and bonds. And
Mhm.
so, for those investors to be able to start considering other asset classes and privately held businesses and assets, that opens up an entire world of investments to them. So that's a
Mhm.
great thing. It allows for greater diversification.
Mhm.
And so let's be more concrete here. So instead of just owning SPI, which is a passive index fund, right? invested in the entire S&P 500. Instead of being limited to those options, you might now be able to invest in a massive real estate portfolio of industrial warehouses located throughout the United States or the world. Or you might consider investing in an infrastructure fund, which is
Mhm.
composed of a bunch of companies that build power utilities and hydroelectric stations. I mean, the sky's the limit. Like private equity has got its hands in everything, and
Yeah.
anything. So it opens up those opportunities to you as an investor, and you can potentially, if this comes to fruition, you can potentially do that through your 401k or your IRA.
Yeah. It's definitely an opportunity to get in with the big dogs, so to speak, right? And can get in. You can think of many different things, from real estate to oil and gas to even whiskey investments. And I keep throwing that because I'm keep seeing this more and more. And there's so many things. Even I don't know, probably funds, VC funds.
Yeah. Oh,
So
absolutely.
yeah, so that's definitely
Yeah.
um, um, a pro. But
And
now, you go
one
ahead.
thing that really bothers me about like the S&P 500 is it's super over indexed to the Magnificent 7, right? Last time I checked, which is pretty recent, the Magnificent 7 account for over 30% of the market cap of the S&P 500. So,
Hmm.
you're not well diversified even though you're invested in 500 companies. 493 of them take up only about 70% or maybe uh 60% of your dollar, every dollar that's in the S&P, and then 35 cents of that dollar are invested in those top 7 stocks.
Right. Wow. So with that pros, right? Definitely we have cons. So what's some of the
Absolutely.
things you can shed light with us? What can be some of the cons that we're doing this?
Well, you know what I love to say, Pedro? You've probably heard me say it 100 times, which is there are no solutions, there's only trade-offs, which is why there are always cons.
Yeah.
um, but alternative assets, the main thing about alternative assets is they very commonly lack liquidity. So if you invest in let's say a restaurant, right? You're an LP in the restaurant. Um, you can't just call in your capital and say, "All right, I want to cash out now. Give me back my 50 grand."
Hmm.
No, that 50 grand's tied up in that business, and you'll get it when the general partner is capable of returning it, meaning they have that cash on hand and they want to return that to you, right?
Hmm.
So you when you invest in a private offering, you hand that managerial responsibility to that general partner, and they're going to generally provide a projection to you like, oh, in 3 to 5 years we expect to provide your principal back to you. But it's just a projection,
Right. Right.
and it might be 2 years, it might be 7 years before you get that principal back. So that's in a that is a big contrast from investing in stocks and bonds, which can be sold at any time. They're highly liquid. So where I see this being potentially very problematic is in the fact that investors might find themselves trapped,
I see.
meaning they need liquidity and they can't get it because all that their retirement funds are tied up in private offerings that lack liquidity. And
Hmm.
where I think this could potentially be really problematic is when somebody starts hitting RMDs, required minimum distributions. So
Hmm.
when you hit a certain age, your retirement, you can't just keep your money in a retirement fund. It's required for you to start taking distributions out of that.
Right.
What
Yeah.
happens if you're 100% allocated to private equity? There's no way to liquidate that. So
Hmm.
they're going to have to solve for that problem. Maybe it's going to be something to the effect of you can only allocate up to a certain maximum percentage into these illiquid funds, or they're going to require those funds to provide liquidity one way or another. They have to solve for that because uh, people are going to get trapped in illiquid
Yeah.
investments.
That kind of brings up as well. There's individuals that would like to borrow against a 401k for some sort of like down payment for the house, or starting a business, which is another strategy using the 401k. Um, but what then if it's your money illiquid? So that's another
That is a very
question.
good point, Pedro.
Yeah,
Yeah,
yeah. So
absolutely.
this is like the beginning stages, right? We are at the beginning stages of the I guess the investment world shifting more into private offerings or alts. And so, but there's a lot of questions that is left out there that we still need to get answers to. So,
Yeah.
yeah.
Uh, Another thing,
Mhm.
Pedro, is fees. People got their
Yeah.
hands in the cookie jar, right? You want to talk about that about with respect to this?
Yeah, absolutely. So, we have been researching and, from experience as well that when it comes to working with an asset manager, there is going to be some fees besides the fees or the operator or the firm is actually raising capital for a deal or private equity. And so there's going to be astronomical amount of fees that is going to be charged to the individual. Now, we don't know exactly. Everyone is different. Every firm is different. So whoever is your custodian for 401k will probably be the first thing to ask. Hey, what are the fees if I'm going to be shifting a portion of on this category of private equity investments or real estate? So and that's a legit question. So that's something that you definitely want to ask. And then one thing to keep in mind is sometimes the fees can go up to 6%, what you're investing in, right? So it just depends. And we don't know exactly like if there's going to be some sort of restriction of how much fees they can charge for an individual that is allocating money through the 401k. And so,
So we don't know what the fees are going to be, but we can
yeah.
definitely say who the parties are going to be, right? So today, if you invest in a private offering, obviously the deal sponsor or the general partner is going to take their fees in the form of typically an asset management fee and then a carry or promote, which is in the industry we often refer to that as 2 and 20, meaning
Right.
20% of the appreciation or the profit from that asset, and then an ongoing 2% fee on the amount that's been invested.
Right.
So
Yeah.
the operator or the general partner or the sponsor, all those three terms are all interchangeable. The people running the deal, which might be Carlisle or whatever,
Hmm.
they're going to take that. They're 2 and 20, but then if we're talking about 401k, where are your funds? They're with a custodian, right? Like, for example, Fidelity. In my case, I have a 401k or an IRA with Fidelity. So the custodian needs to get their piece too. So today, if I were to invest with a private equity firm, KKR, then they take their fee and that's it. But now we're talking about potentially using 401k to do that. So there's going to be at least one additional party, which is going to be Fidelity, and
Hmm.
they're going to want to get their piece.
Right. So those are the channels that you want to pay attention to. How many tiers there are of people trying to help you with your investments. But you ask that transparency, like, hey, be transparent. What are the fees that I'm paying for?
Yeah.
So keep that in mind. You know, um, I think the other thing too is I don't know if you touch much a lot on this, but like the con that we're gonna see is that a lot of people don't know they're gonna have access to the operators. And when you invest something, right, that's the part of the due diligence is understanding what is a track record. Now, the whole thing with using a platform, a third party platform or custodian, right? They're supposed to have some sort of a due deal process, and they do, and they have an extensive paperwork that needs to be done for a PE firm or whoever raising the money to go through. And so, what we know is that it's like more of a, hey, I got this team. They handle due diligence, but you still want to understand what is the asset that they're raising money for and how's it work. You want to understand their track record. So it plays part on yourself too as well to do this due diligence. I don't know. You want to shed some
Yeah,
sense on that?
I think to put it simply, you're not going to have direct access to the operators, right?
Hmm.
So if you're buying into some sort of alternative asset fund via your Fidelity 401k, then you've got a party now. Your
Hmm.
401k custodian is sitting between you and the deal. So, um, so it's just a level of separation, and that does represent risk, right? So, um, it's you when you're doing due diligence on a deal, when you're evaluating whether or not to invest in something,
Hmm.
ideally you have direct access to the operator to ask those questions. But now in this hypothetical situation, we're talking about a custodian being between you and that operator, so you won't have that direct access, so it makes it more difficult, if not impossible, to
Right.
do high quality due diligence. So that is a con, a challenge, or difficulty that may present itself with this scenario.
Right. Yeah. And I'm sure you can ask the custodian and say, "Hey, I would like to learn more about this fund. I wanted to learn more about this firm or this asset." But I'm sure there's going to be certain restrictions. I'm not sure. So if you guys know, let us know for sure. So now, with that being said, right, we are in the beginning stages of this, so we are going to keep ourselves updated with this type of information, and as we go, we definitely keep you guys updated what's going to happen and what are some of the terms that they're going to put out for 2026.
So let's kind of transition here to talking about private offerings, right? So
Hmm.
our focus from the start, for you and I, Pedro, has been talking about directly investing into these types of deals through private offerings. And so let's
Yeah.
talk about how that differs from what we've been chatting about so far.
Yeah.
So it is possible for people to invest in alternative assets through like financial advisors, and their wealth managers if they have one, today. It is
Hmm.
entirely possible to do that, and and people do invest in alts. That is different from when you, through networking or through relationships, find an operator, such as like many of the guests that we've had on the show who are operators, right?
Yeah.
And investors will directly invest through that firm into that firm's projects that they
Hmm.
operate.
Hmm.
That is what you and I are primarily focused on. um, and that's in contrast to a situation wherein you might have a Morgan Stanley uh, advisor, right?
Hmm.
Or any advisor with any broker dealer, and
Right.
they say, "Hey, we have this whole menu of multifamily deals and industrial and this and that and the other on this portal that you can look at, and you can invest in those." And there's nothing wrong with that, but that's not a direct investment through the operator.
Right.
So uh, one of the considerations with that is there's fees that you're paying, right? Whatever broker dealer has presented this menu of curated alternative investments, they've got their hands in the pot. So
Hmm.
for every 100K that's invested into one of those offerings, that broker dealer, whether it's Morgan Stanley or Goldman Sachs or whatever, is getting a piece. That's that potentially up to 6% commission that you were talking about earlier.
Right.
That
Yeah.
that those broker dealers are getting paid. So that's something to know about. If you didn't know that you're paying those fees, surprise, like that's what you're paying.
Hmm.
That's in addition to whatever that general partner is making on the deal itself, which again could be that 2 and 20 that we mentioned earlier.
Right. Yeah.
Whereas if you were to just directly invest through that operator, then you're not paying Morgan Stanley or any other um, broker dealer, right? You are investing directly, and so you're only paying the fees that are inherent in that deal structure that go to that general partner. That's
Yeah.
the difference between a private offering and something that's coming to you through your broker dealer or your financial advisor.
Right. Yeah. Now, when you go on direct, it's important to understand that type of asset. Understand how to ask questions, because that's a trade off, like you said, right? Going through a third party advisor is going to probably do a lot of the work for you, but going direct, it's up to you to do the work and get the information that you need before
Yeah.
cutting that check. Yeah.
So, so that I think that's a good segue into something that a project that you and I have been working on, right,
Yeah.
Pedro? Which is we've been discussing like how can we add value to people who are considering private offerings? Like, how can we help you vet these deals? Meaning, we don't want to vet a deal for you because we don't want to provide investment advice, and we
Yeah.
certainly don't want to convince you to invest or not invest in something. But we certainly want to help you develop the mental framework uh, in considering an investment. So that's what you and I have been grappling with, like figuring
Yeah.
out what's the
Yeah.
best way for us to provide value in that way to our community.
Right. Absolutely. It's something that I think we actually figured this out, right? It's giving the exact process to look at a deal and look at the green flags and look at the red flags. And then you make a decision based on that, right? At the end of the day, it's your decision. So, some of the points that we've learned and what we experience ourselves as well is that when you're going to invest, like others are investing, like family office invest, right? They focus a lot on private offerings, which is direct into a fund or a syndicator or joint venture for a real estate project or so. And that's one. The second one is, focusing on cash flow and not focusing on trends. I'm gonna throw it out there and probably gonna piss off a lot of people, but Airbnbs as an example, it was like the big thing, and everybody's trying to be an Airbnb investor and courses out there, and then it died out, right? So um, just remain focused. The other thing too that people tends to omit, and I noticed this, and this is a no giving, is that don't hire the right team to help you do the due diligence. As an example, right? If you're gonna go buy a business, a lot of people tend to not hire a an attorney, or they don't want to hire a CFO to look over numbers. And I've seen this that once they acquire something, that in the end they tend to lose the business. Now, I'm not saying this happens to everyone, but at least have a team that if this is something that you don't understand, it's like that's you can go ahead and get a team to put that together for you. So the other thing too as well is, and I got my notes here, guys, is the actual, which is really important here, is the peer-to-peer network. So something that I've seen in the past is Tiger 21, our group that we have Beyond Stocks. There's all the multifamily, if you want to focus on multifamily groups. I mean, there's things of that nature, right? We can connect with others who's done it before, in that asset class, and also you can find good deals as well, right? In these groups, and so that's something that you can start looking into. And also, if you're looking for deals at the moment, then you can go and join these groups to find something that is going to be in your criteria. You want to shed light on this?
Yeah, I think a lot of these things that you just mentioned are things that the wealthy do that
Hmm.
they do differently from other people, right? And some of these like people might not have the resources to do, like
Hmm.
the outsourced due diligence, right? Hugely valuable, but also hugely expensive. But to your point, Pedro, that can be um, to a large extent, you can get something like that through a peer network,
Right.
right?
Yeah.
By leveraging the experience of your peers, which then means you need to build that peer network or insert yourself into one, and that, of course, is what you and I are working so hard to build here, both
Right.
virtually, online, as well as in person in Dallas Fort Worth. So
Right.
uh, we want to provide the kind of resources that uh, perhaps the wealthy might take for granted, or not even take for granted, but are capable of having themselves through
Hmm.
their access and their resources. We want to provide a shortcut to that, or an alternative to that, that doesn't really cost anything other
Right.
than your time and effort to be around people who are interested in alts, want to discuss their experiences and provide guidance to others, just because you're because they are passionate about and experienced in and want to learn more about and continue investing in alternative assets.
Yeah. When we can go in depth as far as like the structure, how you should structure your family, business or so, but that's gonna take a long time, and it's something that we are working on. So once we build this, we have this online community that we're looking to build out. You guys will definitely know. So with all that, right? There's two ways to invest in alternative investments. One is through a third party, and I call it a third party through an asset manager, your financial advisor. And this is kind of so everyone can understand is like there is high fees to that, right? But the pro to that is that they've done a lot of, or at least the broker dealer has done a lot of due diligence on the operator. And the other part is investing directly with an operator. Now, the con to that is that you have to do your due diligence, right? Background check, whatever is your criteria, whatever your process is, right? You got to
Yeah.
go through that.
Yeah, thanks for breaking that down. And actually, I was telling you yesterday, right? We were driving to that event in Fort Worth yesterday, and I told you about my friend Brandon. I won't give his last name, but I connected him with somebody who is in need of a hard money loan,
Right.
and so I hit him up. I said, "Hey, Brandon, are you going to do that deal?" He's like, "Oh, still pending, possibly. I'm doing my due diligence." And you know what Brandon's doing? He's hired a private investigator to do a background check,
Yeah.
and and he's doing a lot of other things to make sure that his position would be secured if he were to do that deal. So
Yeah.
he's a very experienced investor, somebody that I really admire because he's done very well for himself as a very good businessman and a very good investor.
Mhm.
But that's the extent that he goes to, and he's obviously spending effort and money to
Mhm.
do this type of research. But it takes money to make money.
Right. Yeah. Absolutely. And again, I do want to say this because I know a lot of people have told me this. Private markets is too much time consuming because you have to do a lot of due diligence versus going and investing into a public company, right? Because the books are open. Like you can literally go through the books, right? Go to the website, download the P&Ls and everything. But um, y- you know, there's pros and cons to each,
Yeah.
right? And so, and we can go down the rabbit hole why I prefer going on private markets than public markets. So, but that's a whole conversation there.
Yeah. That's another
Yeah,
episode.
yeah, absolutely.
Yeah.
So, guys, first of all, I want to say thank you for you guys to been a supporter for us. We've been doing this since January. It's been 6 months, and we have grown our community, and we getting some great feedback, and we're still pivoting. Right? For me, this year has been pivoting and improving, and so any feedbacks you guys have, let us know. I'm open to that. But the whole point here is to start educating others to diversify it into alts, right?
Yep.
So yeah,
And shout out to Jim D again from Orange County, California. He sent me an article which led to this entire discussion.
yeah,
So um, we mean it when we say we want feedback, comments, text, DMs from you guys because that's driving our content. So
yeah,
thanks again, Jim.
yeah. Thank you. Yeah, absolutely. So if it's your first time and hey, or you heard about us and want to know what's upcoming events that we're going to be having, go ahead and subscribe to our newsletter beyond-stocks.com. We are having an event still pending in July and how to invest in storage facilities. So it's a great topic. I haven't had anyone talk about that, and it's definitely something that we are looking forward to. So
We're
um,
going to have an expert
yeah,
talking on that topic.
right, absolutely, yeah. And then also I want to add too, if you have some sort of, we're trying to focus outside of real estate, but if you do funds for M&A deals or you do anything with VC funds or so, hit us up. We would like to know more about it, and we'd love to have you, provide a workshop. And so, because a lot of people don't know how it works, right? So here we go. Absolutely.
Hey, also, I don't know if you saw these comments rolling in, but Jeff Johnson and Ernest Alonso just left us some comments. So thank you guys for tuning in. We appreciate you.
Yeah, thank you. Appreciate it. Yeah. If we can't coming back somehow, this platform won't see you guys won't see our stuff, but definitely thank you so much. All right, guys, stay tuned for the next one. Any questions or so, let us know. And again, sign up to our newsletter. All right, guys, take care till next time. Peace.